Dragon whips its tail. Why China enjoys more foreign investment than India. Dragon versus tiger. Which is more powerful? As two of the world's largest economies, China and India have seen significant growth in recent years. As a result, they've become attractive destinations for businesses across the world looking to expand their operations in the region. So why does China attract significantly more investment from overseas business than its closest rival, India? Has the dragon slayed, or is there still fight left in the tiger? Here we'll examine if there's truth to this claim and explore why businesses might choose China over India. We'll look at factors such as the cost of labour, the availability of skilled workers, the infrastructure, and the political climate of both countries. Decisions, decisions, decisions. When business owners are faced with a decision between investing in China and investing in India, they have to carefully consider a range of factors to make an informed decision. However, when each country presents unique opportunities and challenges, their choice will depend on the specific needs and individual objectives of their business. Of course, factors that are important to one business may not be important to another business. The most prudent approach being to choose the best location for your business is to conduct a thorough analysis of the business's needs and requirements. Let's take a brief look at the pros and cons of each country to understand why companies choose to do business there. Investing in China. There are many reasons why businesses invest in China. Let's take a look at some of the more obvious ones. Large and growing market. At 899 million people, China remains the country with the most populous consumer class, whereas India's is only half that at 473 million. This means that there is a huge potential for businesses to sell their products and services to Chinese consumers. Affordable labour. China has a very large and skilled workforce that is relatively inexpensive compared to other countries. This makes China an attractive destination for businesses that need to manufacture their products at a low cost. Advanced infrastructure. China has invested heavily in its infrastructure, including roads, railways, airports, and ports, making it easy for businesses to transport goods and people around the country. Government support. The Chinese government is generally supportive of foreign investment. This means that businesses that invest in China are likely to receive government assistance, such as tax breaks and subsidies. Technological innovation. China is a leader in technological innovation. This means that businesses that invest in China can gain access to cutting-edge technologies that can help to improve their products and services. It's also worth noting that China is a politically stable country with a strong legal system, making it a relatively safe place for businesses to invest. Of course, there are also some challenges associated with doing business in China. These include the country's complex regulatory environment, the language barrier, and the cultural differences. However, the potential rewards of investing in China are significant, and many businesses have found that the challenges are outweighed by the benefits. Many well-known businesses have benefited from investing in China, including Apple. Apple has a large manufacturing presence in China. The country is a major market for its products. In 2021, Apple generated over $192 billion in revenue from operations in China. Tesla. Tesla has a massive plant known as a gigafactory in Shanghai in China, which is its largest manufacturing plant outside of the United States. The operation has been a major success and has helped Tesla to become the world's leading electric car maker. Nike. Nike has a large presence in China, and the country is one of its most important markets. In 2021, Nike generated over $10 billion in revenue from China. The Chinese dragon. There's no doubt the Chinese dragon is a major economic power and remains a growing market for businesses from all over the world. The country's enormous size also makes it geographically important as a location, especially when you consider its borders. In fact, China borders a total of 14 other countries. On the northern border, there's Kazakhstan, Mongolia, and Russia. To the west, Kyrgyzstan, Tajikistan, Afghanistan, and Pakistan. On the eastern border, there's North Korea and again Russia. Finally, on the southern border, we have Nepal, Bhutan, Myanmar or Burma, Laos, Vietnam, and of course India. which, according to worlddata.info, is now officially the most populous country on the planet, having recently edged China from the top spot. Is it true then that India loses out to China when it comes to attracting foreign investment? Surely India has grown too large for investors to ignore. Indeed, China may not be the number one choice anymore since, according to the OECD, economic growth in India is expected to rise by 6.1% this year compared to China's predicted 5.2%. So, in addition to being the world's largest democracy, what else does India have to offer foreign businesses over China? Let's take a look. Investing in India. Here are some of the main reasons that businesses invest in India. Large and growing market. India has a population of over 1.4 billion people, and with a rapidly growing economy, this means that there is a huge potential market for businesses that can tap into India's growing consumer demand. Affordable labour. India has a large and skilled workforce that is relatively inexpensive compared to other countries. This can help businesses to reduce their costs and improve their bottom line. Government reforms. The Indian government has been making reforms in recent years to make it easier for businesses to operate in India. This includes streamlining the regulatory process, reducing taxes, and improving infrastructure. Tech-savvy workforce. India has a large and growing tech-savvy workforce. This means that businesses can find the talent they need and develop and deploy new technologies with ease. Strategic location. India is located in a strategic location between East and West. This makes it a good base for businesses that want to expand into other markets in Asia, the Middle East, and Africa. India also has several other advantages, such as a stable political environment, a strong legal system, and a growing middle class. Some of the businesses that have invested in India include Apple. Apple has a manufacturing plant in India where it produces iPhones and other products. Microsoft. Microsoft has a large research and development center in India where it develops software for the global market. Google. Google also has a large data center in India which helps it to store and process data for its users around the world. Walmart. Walmart has a number of stores in India where it sells a wide variety of products to Indian consumers. The Indian market is growing rapidly, and there are many opportunities for business that are willing to invest in this dynamic country. Dual energies, yin and yang. Although both countries differ in many ways, as we have seen, they are also extremely similar in others. For instance, they both offer similar market size and potential. The sheer size of both markets offer significant growth potential for businesses looking to expand their reach. They also offer strong economic growth and stability, and both countries are expected to remain economically dynamic in the future. When it comes to market access and regulations, business owners need to assess the ease of doing business in each country. China has made significant efforts to improve its business climate, but bureaucratic complexities and cultural nuances can still pose challenges for foreign companies. India has also undertaken reforms to attract foreign investment, but some regulatory hurdles may persist. At this point, there's very little that could separate these two massive economies when deciding where to do business. So, we need to drill down into the detail. Here are some other key factors that business owners need to consider. Intellectual property protection. Concerns about intellectual property rights can be critical in deciding where to invest. China has had a reputation for weak intellectual property protection, although the government has taken steps to improve this situation. This increased protection offers more confidence to businesses operating in China, particularly in technology and innovation-driven sectors. India, on the other hand, generally has a more favorable record here. Political and geopolitical considerations. Geopolitical factors such as trade tensions, territorial disputes, and diplomatic relations can impact business operations in both countries. Business owners must monitor the political climate and assess potential risks. That said, the political climate in China is more stable than in India, meaning that businesses can be more confident that their investments will be protected in China. India's political climate is more volatile, and there is a risk of political instability. Cultural understanding. Understanding the cultural nuances and consumer preferences in each country is crucial for successful market entry. Companies that invest in building strong relationships with local partners and understanding consumer behavior often have an advantage. Sector-specific opportunities. Some industries may find more favorable conditions in one country over the other. For example, technology companies often find opportunities in India's burgeoning IT sector, while manufacturing businesses might benefit from China's established supply chains. In fact, China has established itself as the world's leading manufacturing hub with a well-developed infrastructure, efficient supply chains, and a highly skilled workforce, making it an ideal location for production and assembly operations, risk mitigation, and diversification. Some businesses opt to diversify their investment portfolio by having a presence in both China and India. This approach helps mitigate risks associated with fluctuations in a single market. And the results are in. Okay, so while China has been a preferred destination for many businesses, India is also an attractive market and has its unique advantages, such as a growing middle class, a vibrant service sector, and a young and skilled workforce. India's potential as a business destination has been gaining more and more attention recently, and some companies are expanding their presence there, so any decision between investing in China and investing in India will require careful evaluation of all the factors that can affect individual companies in many different ways. Indeed, on top of all the factors we've outlined here, there will be many other considerations, such as the local tax regime, the legal system, the availability of land, and the proximity to markets. Although each country offers unique advantages and challenges, businesses will always need to align their objectives, resources, and risk appetite to make the best choice for their long-term growth and success. Either way you look at it, both countries provide a real and present alternative to traditional global markets. In this ever-changing geopolitical climate, stability is one fundamental that all businesses rely on. The dragon may have whipped its tail, but there's plenty of power left in the tiger's punch. There could be no doubt that Asia is the real winner in this battle. If you're interested in learning more about doing business in China, you can visit the website of the Chinese government's investment promotion agency, the China Investment Promotion Agency, or CIPA. Alternatively, if you're interested in doing business in India, go to investindia.gov.in, which is the National Investment Promotion and Facilitation Agency in India. For more information on this business series, check out our channel here. Thanks for watching.